Hey everyone, welcome to the KE Report and a daily editorial on this Monday, May 5th, chatting with Craig Hemke, founder and editor of TF Metals Report. Chatting gold as we usually do with Craig. And Craig, gold's off to a pretty good start this week, up about $80 on the futures market, above that $3,300 level. Look, gold really has, it seems like, just established itself above this $3,000 level for now pretty much all of April and easily into May. The one thing that really stands out to me, though, is when we're seeing all these surveys and forecasts from fund managers, banks, even traders, everybody has much higher targets generally, considering where they were for gold. And pretty much everyone is on board with $3,000 at least for gold through the rest of this year. But now we're even hearing other institutions come out and say the price could be much, much higher. Some nuances with that in terms of what plays out economically. But Craig, take us through what you're even seeing out there in the world of the bigger banks and larger funds now seemingly just really accepting this higher gold price narrative.
Sure seems like it, doesn't it? And hi, guys. Happy Cinco de Mayo. I know Corey's probably about 5 shots tequila into today already, right? I can hear your voice kind of slurring, Corey. So I was
Couple
just,
Coronas too, Craig.
yeah,
You know, you got to
Corona's
balance
going.
it out.
Yeah. Shad's plowing down the nachos.
Have a
Um,
fiesta over here. Yep.
anyway, yeah, isn't this interesting? Yeah, I mean, 15 years I've been doing this, and it always seems like the analysts trail the price, these big banks. It's like, gold's like $1,700 or something, and you get Goldman Sachs or UBS saying, well, our year-end target 2 years from now is 1,400. That kind of stuff. And it's just not the case anymore. I mean, we're getting all these banks that are talking about higher prices. The most recent one this morning, I saw something. Goldman Sachs saying that if recession occurs, they think gold could be 3,900 by year end, which again is what? Another 15% ish from here. Be a hell of a year, too. But they said their structurally bullish view is a base case of 3,700 by year end, and then another 10% gain by about the middle part of next year. But if things really get funky, it could be 4,500. So this year. So, okay, what's going on here? Right? Like, wait a second. Well, as we discussed last week, the banks are all covering their shorts. Since early February on the COT report, I've seen the hedge fund position, long position, get cut in half while the banks are covering their short position. So is that kind of trickling down, from the sell side analysts and the, macroeconomic guys down to the bank, to the actual trading desk, the prop desk, and they're like, yeah, we better just get out of this. We're getting hung out to dry. I'm not sure. But one thing, and Corey, you've mentioned this before, and I think it's important, the lack of analyst coverage that we have in our sector for these, big generalists, like a Goldman Sachs. The sell side equity analyst that is in the mining sector, when he factors in his earnings per share forecast for Newmont and Agnico and Barrick and the rest of the ones that they actually cover, when do they start using these targets? Because if I'm the analyst that covers, again, Newmont, for example, and I see my firm has a year-end forecast of $3,700, and even with Newmont's rising expenses that we've documented ad nauseum, if they start using that as a base case for how much Newmont's going to make this year and in the fourth quarter, well, then hell's bells, how does that not trickle down to everybody else at Goldman Sachs and everybody that looks at Goldman Sachs research? So it's important that these banks are raising their forecasts. Certainly beats the alternative.
Yeah, Craig, it sure does beat the alternative because normally they're lowering their forecast, as you said at the onset. To see these higher numbers, 3,700, 3,900, 4,000 plus, from a number of financial institutions, and the way that the COT reports have been weighted, as you say, more towards the banks holding, not just covering their shorts, but also adding more longs, it really strikes me that the people that love the sector the most, the people that we normally talk to in the precious metals community, and the speculators and the hedge funds and the smaller retail, it seems like the people that know the sector the most love it the least, as the saying goes. There's all these chorus of calls out there for corrections down to 2,900, or boy, I hope 2,900 and 3,000 hold, or we could have lower levels. I've watched over the weekend a lot of videos and technical analysts and a lot of people saying it's overheated, it really needs to cool down. And we have been cooling down since 3,500, but what do you make of the disconnect between where the retail and the speculators and the punters are versus the financial institutions?
Well, one, I think it's just a misreading of the market to say that it's overbought and all these. The only thing I've seen where you could make the case that it's not historically overbought, but maybe traditionally overbought is the distance between the price and the 200-day moving average, which is at levels we've only seen 4 or 5 times in the past. But I would also then say, but that's all those times in the past were a little different economic and macroeconomic and where we are from fiat currency devaluation, all that other things, totally different than it was at all those times in the past. I've also seen people say, well, the monthly RSI reading is high. Okay. But the daily RSI reading, especially as we got into last week, certainly wasn't, it wasn't like it was 90, on a scale of 0 to 100. It was back down in, to 60. So to some extent, Shad, I think it's PTSD. I think those of us in this sector that have been at it for, devoted so much time of our lives to it, just feel like, well, the hammer's going to fall, that something bad's going to happen and all this is going to get yanked away from us. So we better not get too excited about, because that's how it's always worked in the past. And I'm not trying to tell you this time is different, but this time is unique versus all of those other episodes. This is not, it's not the same set of circumstances. So again, at the end of the day, I think a lot of people that have been in the sector a long time deal with PTSD, post-traumatic stress disorder. And that prompts us to think, well, it just can't keep going up, it can't keep going up 25% a year. And maybe instead it should be, well, why is it going up 25% a year? Maybe that's a better question rather than making declarative statements about how it has to be a pullback.
Craig, I also find a lot of people are also looking at the stocks that they hold underneath the metals price. And I still think this is a very good market for these stocks, but there are a lot of the juniors and even some mid tiers that are not doing very well. Some that are trading near all-time lows, or at least 52-week lows. Again, there are also a lot of stocks that are doing very well, but it is also interesting to see all the money flowing into gold-backed ETFs and money still exiting the ETFs that follow the gold stock. So isn't that also an issue for all the diehards that are in this sector? They don't just trade gold. They actually, usually they just buy gold and they don't use that as much of an investment. They go down into the gold stocks, and unfortunately they also get sucked into a lot of the smaller gold stocks, and those quite frankly just aren't performing for them.
Yeah, and that drives a lot of sentiment for sure. Because again, as much, even me personally, my story has always been, got to buy and stack physical metal, because that's your only protection against this, this monetary madness and the end of the debt-based monetary system, or the reset of it, or however you want to put it. But I too, hey, let's buy these mining shares. Look how cheap they look. A lot of it is a function of when you bought them, right? I mean, I was very fortunate in that I completely swore off the sector in January of 2013, and then just by chance started buying back in at the end of 2015. So my cost bases are, like great. But for the people that bought them, in 2011, how far down is the GDXJ from those highs? I mean, still 70% down or something from those highs 10 years ago. I think that you're absolutely right, Corey. That carryover and you just waiting game, you don't understand. That was like, I'm sure you guys have spoken about Hecla, the earnings. And again, I have no idea. I couldn't tell you if Hecla's earnings are good or bad, but I know a lot of people on my side were like, yeah, well, what can they do? I mean, all it does, the stock puts out, reasonably good earnings and metals in the 30s, and the thing goes down 20% in a day. And so I do think that really does have a big impact on sentiment. At the end of the day, though, we need gold to keep going up. Eventually, that'll drag silver higher, and that will begin. I know we've, again, discussed this for years, that will begin to bring more people into our party room. It's just a gradual process. Most folks want it to happen a little quicker.
Well, Greg, I hope more people enter the party room and join us for Cinco de Mayo festivities in the silver and gold space. But I tell you, I probably get the most questions, Craig, emailed into me about silver. People wondering why it's not moving like gold, why the silver stocks, if you look at SILJ or SIL, are so beat up. I went on somebody else's show last week, and they're generalists. They don't care about the metals. And it's like, yeah, but look at silver, Shad. It's terrible. Look at the silver stocks. It's like, actually, silver is okay where it's at. But I agree with you. The silver stocks are nothing to write home about. How are you looking at silver and the silver equities through the current lens of will gold eventually lift it higher, or is it on its own trajectory?
It will. It's a little bit, and what I keep waiting for is a little bit like what happened last year at this time, where gold broke out on the 1st of March and then rallied all through March, and silver didn't do anything. And the ratio got to 100 to 1. And then finally, silver started to break out and catch up. And it went from 23 to 33 in about 6 or 7 weeks by the middle of May. And in a sense, what I've kind of learned over the years, and maybe this is anecdotal, maybe it's, whether it holds water or not, silver almost creates its own momentum. It's like you got to apply a force. Inertia doesn't or come on its own. You got to apply a force to an object to get it moving. And then once it gets moving, maybe gravity can take over. But to begin with, it's just sitting there. So you got to apply a force to it. And silver's kind of the same way. It just sits there. And nobody wants to own it because it just sits there. But then in the times when it's really taken off, it's when everybody starts piling. Oh, okay, here it goes. And we definitely have that set up now because everybody's watching it. Like you said, even these generalists are watching it. And as gold keeps going up, I shouldn't say it, because as gold keeps going up, I forecast I think Goldman Sachs probably has the right idea. Then everyone's going to sit there and wait. Okay, well, silver's going to go, but I'm not going to buy it I'm not going to buy any options. I'm not going to buy the silver miners until it starts moving. Then all of a sudden, it does get above 33. And then all of a sudden, it's 35. Okay, well, we're going to wait to see if it gets above 35 because that was the highs it got last year. And then when it gets above there, again, it starts to create its own momentum. And everybody starts rushing in. And then the people that didn't buy at 30 are like, damn. And then they're waiting for a pullback and trying to talk it down. That's generally how it works. And again, we just haven't had that inertia applied to it yet. But that moment will come. Last year, I mentioned this. It happened on Easter Sunday night, March 31st. I mean, when no one's around, all of a sudden silver's up like $1. And then it went from there. And so something like that will probably happen again this time.
Craig, isn't the market just telling us right now, though, that people are nervous about the economy? We're hearing recession. We're even hearing depression calls. And a lot of that is what's driving the gold price up. But you look at the gold stocks, you even look at silver, they're more speculative vehicles. Investors need to want to take some risks. They need to get aggressive to get that leverage off of the underlying metals move. But right now, it seems like everyone is just so concerned with the road the economy is going down, the road trade is going down, that they're not necessarily looking to get super aggressive with their trading accounts.
Oh, I think that's absolutely right, Corey. I mean, and that certainly factors into it too. I mean, we're not in a place where the Fed is printing like crazy, like back in 2011 when, QE2 started or was announced in November of 2010. They're never going to do QE again. There was a one-off, and all of a sudden here came QE2 in November of 2010. And when that's in full flight and everybody's, boom, that's when, silver took off. So you need that kind of sentiment as well. No question about it. But the other thing, again, I still believe that one of the, if not still the primary price discovery place is the futures market. And within the futures market, you'll recall we used this term a couple of months ago. It's dichotomous in that the structure of the commitment to treasury report for gold is terrific. I mean, it's as favorable as it was when gold took off in March of 2024. I mean, price is 50% higher or more. But the structure of silver is, it's far from terrific. It's not terrible, but in terms of how many of the usual market participants have already bought, be it hedge funds or whatever, that's where we stand. I mean, there's just not a lot of new money coming into silver. I mean, the open interest is down at 130 some odd thousand contracts, which is the lowest it's been in months. So there's just, I mean, until you get actual demand from speculators, like you said, Corey, actually buying the futures contracts and the expectation that, they're going to go up, then we just kind of mess around. And when we have positioning in the silver market that's the same as it was back in March, or, the same as it was last year, it's pretty hard to see where there's new buyers, where they're going to come from. And that's obviously holding back price as well.
Well, Greg, speaking of where the new buyers are going to come from, let's just maybe broaden it back to gold again because it is the prime mover. You mentioned that, a lot of these financial institutions are raising their targets 3,700, 3,900, 4,000 plus. And you said it's more important to focus on why gold is going higher. Now, I know that the main backdrop is the ends of the Keynesian experience, as you've mentioned many times, but it was for a while that it was the Fed that was really moving the markets, and everybody had a Fed obsession, and like, what are they going to do? And then for a while, it was, rate hikes are going to be bad for gold, but then gold rose during the rate hikes. Well, rate cuts are going to be rocket fuel then, or maybe they'll be bad. Or then it was look at the geopolitics, and there's wars in Ukraine, and there's wars in Israel and Palestine, and what if Taiwan gets invaded by China? Now there's conflict with Iran. All of that geopolitical stew is out there, but not a lot of it has really changed. What is actually going to drive gold from the low 3,000s up to the low 4,000s? Is it monetary? Is it central bank buying? Is it a falling dollar? What do you think the catalyst is to drive precious metals higher longer term?
Well, and for folks that listen to us, at least occasionally, they'll recognize this discussion. I mean, there's something fundamentally changed back in the beginning of 2022 with the war in Ukraine. And the gold has broken its long-term relationship with we'll call it current real interest rates, where gold has tracked real interest rates up and down. That has broken, has left everybody confounded as to why gold has rallied so much. And at the end of the day, it's central bank demand, net total 22 through 24, about 3,500 metric tons. And it's that central bank demand that underpins price now. It's that central bank demand that I think is undeniably behind the issues, the delivery delays in London and everything else. And so as that central bank demand continues, and again, I think you can trace it back to the beginning of the Ukraine war and the U.S. kicking Russia out of SWIFT and everything else that happened back then, that just continues to underpin price and keep the pullbacks from being shallow, and keeps the banks and the commercials that are typically short from giving them a chance to cover those shorts, in a declining price, because price, even like last week, all of a sudden it's going down, then all of a sudden it turns around, comes right back up, and we're right back today where we were, back on May Day, when all of a sudden, it looked like they were going to run us down for a few days. I think the other part of this answer, Shad, is people need to ask themselves, what has changed since December? Because we had a heck of a run last year, obviously, and you could lay that at, we were still going really well all the way up until the week before the election. Gold was $2,700 or whatever it was, 28, and then went through a very sharp correction and pulled back 10%. And everybody's like, oh boy, here we go. And then since December, the Fed meeting, was really the lows in the middle of December. I mean, it's been a really steady, consistent trajectory upward, consistent channel, some dips below, some moves above, but really steady. So what's going on here? What do the internal participants of this market know that we don't know? We're all left scratching our head going, oh, there's got to be a pullback soon. Oh, all these different is overbought. And all of a sudden gold just keeps on chugging. What do they know? That's the question we got to get to. Because I think there's something, whether it's, we got a hint from Besant back there on February the 3rd when he's talking about it, monetizing the balance sheet, and all this kind of stuff. I don't know. But I sense that these banks, who are obviously closely tied to the Fed and Treasury as primary dealers, I suspect they know, which is why they're covering shorts, which is why they're raising their forecasts. But there's something there that we're all missing, and unafraid maybe to plant the flag and say, this is it, because we don't have all the information. Something's going on. Something has structurally changed. And those that are calling for tops and 20% pullbacks and stuff are probably not, they're not privy to the information either.
Well, Craig, to this point about something that's structurally changed, we for years talked about that one universal chart, how markets really move together, and that even included the precious metals. That doesn't seem to be happening anymore. Markets are really moving on their own accord. So I guess that's more credence to what you're saying that maybe these markets have significantly shifted.
Yeah, maybe because again, yeah, there was almost like a risk on class, that made up the one universal chart, and then the risk off, and they all moved opposite of each other. But it is pretty remarkable, the stock market, the bond market to a great extent. Depend, however you want to class them all together. Gold is outperforming all of them and consistently moving up. Like I said, I mean, I don't know anybody print off like a 6 month chart and then just kind of draw a big arrow on it going back to the middle of December. You see gold just kind of just keeps tracking along. It dips down, rallies up, but it just keeps tracking along. So it makes it sounds like this big, look at this big thing going on in the back, but something has changed. Something is driving this consistent bid. And it ties in with what, these forecasts from these banks that have always been bearish. And it ties in with the bullion banks or the commercial category covering shorts and moving price even higher. There's something there that I suspect we'll look back upon, I don't know, a few months from now, by this fall, whatever, we'll go, oh, okay, now I get it. There's something happening behind the scenes, and we'll just see how it all plays out.
Yes, we will. Right now, though, just interesting to see precious metals, gold, really just outperforming the markets on even a longer term time frame. So clearly, people are nervous about what's going on, and that's what you keep on reading in the news too. The inconsistency and the fear that people have after what we saw was a bad first quarter of contraction of GDP in the US and all the reports of how companies just don't know how to navigate this current climate is filtering into precious metals doing their job as a protection asset. Craig, we'll wrap it up here. Again, Craig Hemke, founder and editor of tfmetalsreport.com. We'll post that link in the show notes. Craig, great chatting with you. Thanks for taking some time with us. I hope you have a great rest of your week.
Thanks, guys. And Corey, slow down on the tequila, okay? You got all day. So hang in there, all right?
Craig, let's wrap it up so I can go have another shot, man.
There you go. Let's do it.